Chapter 3. Self-empowerment via trading software. The value of self-empowerment. Learning to trade successfully on the Forex is about self-empowerment and independence. I personally believe that self-empowerment is learning how to fish, and that dependency is all about being handed a fish to stay alive. I know there are many companies out there offering education, trading strategies, and even trading systems that claim to take you from rags to riches in a short period of time. Make no mistake, there is no holy grail. You cannot buy any indicator or trading system that works 100% of the time any more than the airlines can buy an autopilot system that eliminates the need for pilots. If you are being courted by any company that is leading you to believe you can buy a trading system with buy and sell signals that will take you from rags to riches, you will be greatly disappointed. Let us say you created a trading system that worked 95% of the time, or that allowed you to double your money every few months just by following the trading signals. If you created such a trading system, would you sell it for $1,000? Or $3,000, $5,000, $10,000, or even $50,000? I would think not, because if you could create such a trading system, all you would need to do is walk into any major financial institution like the Bank of America or the Royal Bank of Scotland and show proof that your automated system works. If it did, the bank would likely be willing to pay you $1 billion or more for it. Just as there is no perfect trading system, there is no autopilot system that works without a pilot. I very much doubt that human beings will ever put their lives on the line with a computer or autopilot system in an airplane without a pilot. We all have bought enough electronic equipment in our lives, TVs, VCRs, cameras, and so forth, to know they all fail eventually. Don't put your hard-earned money in a get-rich-quick scheme. Pilots are educated and trained to fly proficiently before they are even shown where the autopilot system button is. I will never forget back in 1984 when I got my private pilot's license. The first time I got into the cockpit with my instructor, I asked him where the autopilot button was. He looked at me and said, "If you ever ask me that question again before you get your private pilot's license, I will throw you out of my class." Well, I never asked that question again, even after I got my license. I did eventually learn how to engage the autopilot function, and will have to say, the autopilot system is not a fail-safe function without the close monitoring of a pilot. As powerful as such systems are, when things start to go wrong, they cannot make split-second decisions in the best interest of the passengers. They can only do what they are programmed to do, and there are too many variables in flying to program absolutely everything. Autopilot systems do not work 100% of the time, they have their limitations. As a trader, you will learn that, from time to time, the trading environment will be ideal enough to use an autopilot system. There are some good ones, but they don't work all the time. You need to realize that the market can turn turbulent at any time, and if, all of a sudden, it does turn turbulent, you will have to have the capability to sit in the captain's chair and bring the aircraft back to the airport without any major incident. That is truly successful trading. I will never forget September 11, 2001. I was sitting in my office at home and had been in a few trading positions for a couple of days on 4 different currencies. All of a sudden, they all took off like rockets in the opposite direction of my positions. Thank goodness I was not using an autopilot trading system, or I could have been financially wiped out that day. I was stopped out on all 4 currencies and was able to preserve what profit I had made. The reality is that to become a successful trader, you must go through an education process no different than that of becoming a pilot, a physician, or of any profession that requires a specific discipline to be mastered. I never cease to be amazed at all the marketing gurus who start Forex education training companies or attempt to sell Forex buy and sell signals and prey on the ignorant by promising them untold fortunes on the Forex for the bargain price of $995. I am even more amazed at the massive amounts of people willing to purchase these products. But I am never surprised when they call our office and share their experience of buying a Forex program that failed or disappointed them. These traders are now pleading for help because with their current system, they keep on losing money and have no idea how to make it back. Clearly, what they purchased doesn't work for them in the market. I guess experience is what you get when you don't get what you want. A fair question is, did the system truly fail, or was it the system found between their ears that failed? You must be taught how to use the best tools available for whatever profession you want to pursue. If you are going to be a ditch digger, you need to be taught how to use a backhoe as well as a shovel and be taught in which situations one or the other should be used. Learning to trade on Forex, from someone who is already successful at trading, is critical. Finding out which trading tools they use is equally important. Now is not the time to go bargain hunting for tools. Bargain hunting for free or low-cost trading tools is like learning to navigate on the ocean with a compass in a 12-foot canoe, clearly the wrong vessel for the environment. A solid-built, 1,100-foot, state-of-the-art cruise ship with all the latest gauges for weather would be wiser. With so much at stake, do not take a shortcut on paying for quality trading tools. When it comes to trading on Forex, I highly recommend the MTI 4.0 charting package, see Figure 3.1. It has more than 150 trading indicators that can be used in creating trading systems that align with your trading personality. These systems can be backtested over many years instantaneously, allowing a trader to see if their trading strategy is a good one, or if they are working in the wrong direction. You can create a trading strategy that aligns with your personality, program it into a system, backtest it, and, if it is productive, have the trading system send you alerts via email or cell phone when an entry and/or exit signal is triggered, see Figure 3.2. The most important part about a trading system is that it must be simple and easy to use. Whether it is done visually or created by a trading system, your trading strategy must have three very important components. 1. It must be able to find the current market direction. 2. It must have a consistent entry strategy that works consistently. 3. It must have two very clear exit strategies, one for protecting you against major losses and one for capturing a profit. How to determine market direction. The MTI 4.0 charting program helps traders determine market direction. In Figure 3.3, you can see a line that goes above and below the price movement against time that is monitored by a computer creating a candlestick formation. Candlestick formations are a way of monitoring the open, high, low, and close market prices in any given time period. This line is called a moving trend line, a visual indicator of market direction or perhaps the current trend. When you turn on your computer and begin to review your charts on any time frame, if the current candle is above that line, the market on that time frame is in a potential uptrend, and if the current candle is below that line, the market on that time frame is in a potential downtrend. No matter what time frame you trade in, this simple exercise accompanied with this system can help you determine trend direction. The indicators on a chart can become like the autopilot button on an airplane. However, as discussed previously, airplanes don't fly themselves, they need pilots. Before you use an autopilot program, you need to understand how it has been programmed. Indicators and oscillators, which are nothing more than mathematical equations that are monitoring price movement against time displayed via lines on a chart, see Figure 3.4, are one way to determine market direction. Looking at the moving trend line on any time frame can help you determine market direction on that time frame. One mistake traders often make is believing that a trading system created for a 30-minute chart will work on all time frames, such as a 1-hour chart or a daily chart. Sometimes it does work, but typically, as you move a trading system from one time frame to another, you may want to adjust the settings of such a system to optimize its performance on that time frame. It is vital to find trading software that will not only allow you to change these settings but also instantaneously backtest the results as found incorporated in MTI 4.0. Using indicators to determine an entry point. Once you have determined market direction, you need an entry trading strategy that works more times than not. Every trader wants the market to move in his or her direction from entry. There is nothing worse than getting in a trade and having the market run in the opposite direction. One of the most important traits of a successful person is that when they are trying to make a productive, empowered decision, they gather facts. The more facts they can gather, the more informed their decision. Trading is 10% skill and 90% emotion, which is why our emotions frequently stand in the way of making good decisions. Anytime you need to make a decision, do yourself a favor and do not make it while you are in an emotional state. Take the time to calm down and place yourself in a logical state of mind. If you do that, you will open up the left side of your brain, where all your knowledge is stored, where all your intellectual recall is, and you will have access to everything you have learned in your past that is productive. You will begin to make an educated, positive, and productive decision. Trading indicators can keep you from using the right side of your brain, where all your emotions are stored. You can program buy and sell signals that have no emotion, they just monitor price movement against time. Using different indicators together can create effective entry points, like the ones found in Figure 3.5, but they need to be manually monitored. The trading system you are looking at in Figure 3.5 is called the MTI Trend Scalper. The two moving lines overlapping the candles are moving trend lines, which can act as buy and sell signals. The line closest to the candles is a moving inner trend line and the other one is a moving outer trend line. When the inner trend line crosses over from the north to the south, it is time to sell, and when it crosses over from the south to the north, it is time to buy. In Figure 3.5, top, you can see that if you used the moving trend lines as your entry and exit signals, right around March 10, 2006, you would have bought the euro at approximately 1.2000, or when the lines crossed, and sold it around June 15, 2006, at 1.2800, when the lines crossed again for an 800 pip gain. That is an $8,000 profit from a $1,000 investment from a 3-month trade, which is considered long-term trading. But where do you get in if the moving trend lines have already crossed? Do you have to sit there for another 3 to 6 months before they cross over again to find another trading opportunity? The answer is no. You can have two options. You either educate yourself how the markets move without using indicators, or you learn to add additional indicators to your trading system like the waving line you see at the bottom of the chart in Figure 3.5. This indicator, called the MTI Trend Tracker, monitors the waves of the market. As the market moves, it resembles the waves of the ocean. The market does not just take off in one direction, it waves as it moves, rallying and retracing, ebbing and flowing, 3 steps up, 2 steps back, 3 steps up, perhaps 1.5 steps back before it goes back up again as it creates its trend, making higher highs and higher lows. The greatest part about a trading system is that it is constantly monitoring the movement of the market, projecting directions with entry and exit points 24 hours a day even while you sleep or work. Using a trading system allows you to control your trading in the market, rather than the market controlling you, and to come and go, or turn off your computer, without having to do all kinds of new technical analysis of the market to catch up from where you left off. If the lines overlapping the candles crossed while you were away, the MTI Trend Tracker allows you to enter the market at a price point where the market will more than likely reverse and rally back up in your buying direction from entry, which is what every trader wants. Look at the MTI Trend Tracker indicator where you see the bold up arrows, see Figure 3.5, bottom. When the moving line is going south and then U-turns to the north, the market should follow. Look at the price movement of the market and how it began to rally again. This trading system works just as effectively in a downtrend as it does in an uptrend, as you can see in Figure 3.6. All the rules are the same but in the opposite direction. When the lines overlapping the candles cross from the north to the south, it is time to sell. Once again, if you turn on your charts and the moving trend lines have already crossed, giving a short signal, you can enter when the MTI Trend Tracker indicator moving north U-turns to the south. Look at the market movement on the charts after the U-turn toward the south. Using trading indicators eliminates a lot of the guessing and allows you to focus on developing a trading strategy that works consistently, on a time frame that suits your personality. Some traders like fast action and want to turn their computer into a video game. They want to quickly scalp the market. In and out, perhaps 10 times a day. If you're one of those traders who enjoys scalping the market, you may want to trade using 5-minute to 30-minute time frames or charts. If you enjoy day trading, use this trading system on 1-hour to 4-hour time frames, and if you enjoy long-term trading, use this trading system on 4-hour, daily, or weekly charts. In any of these cases, you let the computer do the majority of the work. It looks easy, doesn't it? Just like an autopilot system. If it were that easy, however, we would all be living in gated communities and flying our jets to our beach house estates every weekend. Of course, it isn't. Most traders make their money during trends and lose it when the market gets turbulent or begins to go sideways. Sideways movement in the market is when the market begins to bracket or consolidate, creating equal highs and equal lows for a period of time. See Figure 3.7. What if you were just starting out and the market began to go sideways, or consolidate, as shown in Figure 3.7? Just about every time the computer gave a buy signal, the market went south, and just about every time the computer gave a sell signal, the market reversed and went north. When most people board an airplane and look inside the cockpit, they are intimidated by all the gauges they see. They say to themselves, "I could never do that." But the reality is, they could. How do I know? I used to say the same thing when I boarded those same planes, and I am proud to report that I received my private pilot's license back in 1984. Just like when I turned on my computer back in the 1980s and looked at charts, I, too, was extremely intimidated. But believe it or not, sideways movement can potentially offer the trader more trading opportunities than trends. Envision buying all the lows as seen in Figure 3.7 and exiting at the highs and then reversing your position, shorting the market by selling all the highs, taking a ride across the trading channel and exiting at the lows. It is clear to see by continually repeating this process that there is profit to be made. Using indicators to determine exit strategies. When going long in the market or buying first to enter the market, every buy entry order needs two sell exit orders, one for profit and one for loss. Conversely, when going short or selling first to enter the market, every sell entry order needs two buy exit orders, one for profit and one for loss. After you enter the market, you need the two exit points, one for profit and one for financial protection should the trade not work out. The fact of the matter is that no one knows where the next pip will go. The best you can do is to understand how the market works and learn how to go with it. It's like navigating in the ocean, it can be predictable at times and very unpredictable at others. But success comes to those who understand how it works. Just look at the people who have been able to create great companies that haul freight, passengers, or oil over the ocean. After the market has moved in your direction from entry, as planned, the question is, where do you get out? The last thing in the world you want to do is guess what the market is going to do next. Let a simple mathematical calculation of price movement against time tell you instead. You can use your indicators to make your exit decisions as well. Remember the two indicators, the moving trend lines that are overlapping the candles and the MTI trend tracker at the bottom of the chart? If you take a long position and want to become a long-term trader, you may want to stay in until the moving trend lines cross over. However, if you only want to grab a few pips, and you entered using the indicator below, you may want to get out after that line has moved from the south to the north and is beginning to U-turn back south, see Figure 3.8. Some traders use the movement of their indicators as their protective stop-loss orders. They let the indicators make their decisions regarding when to reverse their positions. I don't recommend this, because you are letting your emotions make your decisions. How? If you do not have a clearly defined exit point, you will get caught up in the hope and fear trap. Once the market moves against you, and you are relying on the indicator to tell you what to do to get out with a small loss, well, guess what? Your hope and/or fear will get the best of you. The best place to put your protective stops are a little beyond the latest major level of support or the last low if going long, and a little beyond the latest major level of resistance or the last high if going short. What is critical is finding and calculating where your protective stop order needs to go as you are making your trading plan. Once you find that location, after you enter the market, place that order immediately and do not move it. If you are trading in OCO, one cancels the other order. Trading is about keeping your losses small and letting your profits run. The problem with most Forex traders is they hold on to their losses and quickly dump their profits for fear the market will take them back. They have the definitions of hope and fear backwards. They will hold a losing position for days, sweating it out, walking through the valley in the shadow of death, praying, hoping, promising God and everyone else that will listen to just help them get back to break even, and once they do, they dump their position after only capturing a few pips. Some traders will go 300 pips in the red to only exit after a brutal ordeal and capture only 2 pips. Learning where to place your protective stop-loss orders and creating a trading plan before you trade is of critical importance as a novice trader. Below are some trading tips for novice traders. Keep your exit strategies simple and never risk more than you are willing to make. Trade using smaller time frames, perhaps 30-minute, 15-minute, or 10-minute time frames. Trade a simple strategy with a clear entry order accompanied by 2 exit orders trying to capture a profit of perhaps 10 to 20 pips. That is $10 to $20 in profit on a mini $10,000 account and $100 to $200 on a regular $100,000 account. As a beginner trader, you want to set a goal of trading 7 out of 10 times successfully, making more money than you lose by trading on smaller time frames, before moving to larger time frames. Your aim should be to establish the habit of winning more than you are losing. After you get in the habit of winning more than losing, and realizing that losing is just as much a part of this game as winning, you will then be able to move to a larger time frame to capture more pips, perhaps capturing 40 to 80 pips at a time, consistently, 7 out of 10 times with some losses. The most important part of this process is forming successful trading habits. After you get the simple basics down of winning more than losing, you can start learning more advanced exit strategies. Using multiple time frames to trade. As you look at multiple time frames, always remember that the movements on the smaller time frames are controlled by the movements on the larger time frames. Take 2 different time frames, for example, a daily time frame and a 4-hour time frame, using the same MTI trend scalper trading system on both time frames. Remember the MTI trend tracker at the bottoms of the charts, which monitors the wave movement? Look what happens to the price movement on a 4-hour chart when the indicator U-turns on a daily chart, as seen in Figure 3.9. The prices U-turned on the 4-hour chart, didn't they? Remember, prices on a smaller time frame respond to the movement on a larger time frame. This works the same on all time frames and is a great way to trade. Conclusion. All successful traders create a trading plan and trade their plan. After you create a trading plan, cross-check it with the MTI Grade Your Trade checklist. The MTI Grade Your Trade checklist allows you to attach percentages to the probability of success of your trade. The MTI checklist cross-checks important points for your entry and exit. These 7 points are graded, indicating the odds of your making money, and include the use of indicators, candlestick formations, Fibonacci, Fib, numbers, counter trend lines, and more. Trading needs to be fun and simple. Anyone who tries to impress you with all their knowledge and indicators, see Figure 3.10, will only confuse you. A confused mind is going to take you down a path of financial destruction. Stay clear from using too many indicators or complicated indicators. Keep it simple. The end of Chapter 3.